best in radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome, and you are listening to the Financial Survival Network. It is Monday, October 20th. Hopefully, we will be through with this month very shortly before any more damage can be done. Last week was the taper tantrum and the Ebola balance sheet. Here to talk about it is John Rubino of DollarCollapse.com, co-author of The Money Bubble. John, hello.
Hey, Kerry. How you doing?
All right. So, hey. Last week, man, nightmare on Wall Street and nightmare on Liberty Street for the New York Fed. And are we going back to QE like the rest of the world because they've run out of their bag of tricks? I mean, it's empty, right? So we go back to what works or what doesn't work, right?
Yeah. Well, the consensus among your guests seems to be that we were never going to be able to end QE. And even if we did end it for a little while, the markets would freak out and they would have to go right back to some kind of huge debt monetization program, no matter what they call it, in the year ahead. And we got a sign of the truth of that perspective last week when the markets heading into the end of this current QE program just tanked. They really fell off the table. And then towards the end of the week, a Fed governor came out and said, well, maybe we'll stretch it out a little longer than we thought we were going to. And the markets went right back up. So I think in the Fed right now, they must be just sitting around the table laughing about how easy it is to manipulate the financial markets. They don't even have to actually do anything sometimes. They just make a vague announcement or have somebody say something in an interview. And the markets are so desperate for continued liquidity that they respond instantly to just the intimation that there might be a little more liquidity coming out of the Fed than thought, And so we stabilized towards the end of the week. And now today is not an especially volatile day. So, who knows? We'll see. But I am among, your guests who don't think that we can live without really aggressive debt monetization because we build up so much debt. And so much of it is really bad paper, that would just go bust without continued infusions of new cash that we really, as a global economy, have to inflate or die, as Doug Nolan at Prudent Bear says. And so if one country decides to stop its debt monetization programs, like the Eurozone has done over the last few years, then they instantly drop into a recession. And that's what happened to Europe. And now they're talking about their own QE program. And Japan, of course, had a strong currency for a few years and relatively tight monetary policy. And they were dropping into a recession. And then they went to Abenomics, which was a super aggressive increase in their central bank's balance sheet. In other words, the Bank of Japan was buying back a lot of bonds with newly created yen over there. And now it's the U.S.'s turn to try to wean itself off of easy money and probably to find out that it's not possible. So I think we're heading for a time in the not too distant future when all the big central banks are in a synchronized fashion buying back bonds and creating new currency and dumping it into the banking system. And that's when things get really interesting because up till now, it's been kind of, one country doing it, one country not doing it, back and forth. And once everybody's doing it, then we find out just how powerful central banks are, if they are indeed able to inflate away a lot of this debt. And I kind of think that whatever they do, they'll do it wrong, just based on the history of the last 20 or 30 years, so that we will end up with more volatility rather than any kind of sustainable growth. But right now, the focus is on the U.S. Can we actually end the current QE program without the markets freaking out? And it looks like we cannot. So the next couple of months are going to be really interesting from a theoretical standpoint and from an investing standpoint. We're going to see another huge market collapse like 2008, 2009, or will we see a continuation of the global asset bubbles that have pushed the price of a lot of asset classes around the world up to levels that normally precede crashes. Can we go through those levels and just keep on going? We'll see. This is uncharted territory, and it's a very, very interesting experiment that we're running, but one that's ultimately doomed to failure. It's just a question of when it fails.
Well, I think Ned Schmidt kind of summed it up best. It used to be it was 3 steps and a stumble. The Fed would raise rates 3 times. They'd raise the Fed funds rate, and then the market would tank. Well, now they're not raising rates for obvious reasons. They can't do it. So instead, they're lowering QE, and that's the equivalent because it's sucking liquidity out of the market, I guess. And the result is the same, except they cut it like 3 or 4 times. But the end result, I think, is about the same. And the market suffers, and then they got to go, scrambling and figuring out how they're going to raise liquidity again.
Well, yeah. Scaling back asset purchases is functionally the same thing as raising interest rates for the Fed. And you saw what happened in the last couple of months is the dollar started getting really, really strong while the Fed was scaling back its asset purchases, because basically it has been forcing down interest rates, and by doing so, forcing down the value of the dollar for the past few years via QE programs. So you take that away, and naturally the dollar goes up. And that was enough to send the markets into turmoil. Just having the dollar index go from whatever it was, 79 up to like 86, not even a 10% move in the value of the dollar, but it happened very suddenly, and it looked like it was going to continue. And that was enough to scare the markets, because a stronger currency is a good thing if you're a healthy economy. You see it as a sign of the rest of the world's confidence in your ability to manage your money when your currency goes up in good times. But when you're grossly over indebted and your economy is kind of slowing down to begin with, a stronger currency can push you over the edge into a debt-driven deflation that turns into a depression. And so that's the risk that everybody's running now, because we're all grossly over indebted. We've all borrowed way too much money. And borrowing too much money is an inherently deflationary strategy, because you've got a lot of debts that are going bust. You've got a lot of companies that are in danger of defaulting on their debt once you reach a certain level. And you have a huge demand for your currency, because everybody who's borrowed money in your currency has to get those dollars or euros or yen or whatever in order to pay back their debts. And that puts upward pressure on the value of the currency, which is deflationary. So that's the natural state of the global economy. It wants to be in deflation. It wants to have a 1930s style crash followed by a depression. And so the central banks of the world are leaning against that by creating a lot of new currency and dumping it into the banking system. And so far, they've been able to stave off a 1930s style crash, but it's been at the cost of, depending on how you calculate debt, 20 trillion or 30 trillion or $100 trillion of new debt around the world taken on in the last 5 or 6 years. And so that just increased the deflationary forces that are now leaning against the economy. And it's leading the central banks of the world to have to up the ante. So the next round of QE from Europe and the US and probably from Japan and maybe from China, it's all going to be bigger than the last round. And so there's really no end in sight to this, because the previous QEs did not result in organic growth. Escape velocity, where individuals and companies are borrowing enough money and spending it, and the economy is growing without help from the central bank. We didn't get that. So the bigger numbers that they're going to try next probably also won't result in the kind of success as they define it in Keynesian theory of, lots of internal borrowing in a society and consumer spending, et cetera, et cetera. It just won't work because we're already too indebted. But what it will do is increase the amount of debt that we've got and increase the deflationary pressure on society until something gives one way or another. The system isn't going to resolve by going back to a time of 3% year after year growth and, consumer spending that is sustainable and steady. We can't get back there because we borrowed too much money. So we're going to resolve one way or the other, either with a huge deflationary collapse or some kind of currency crisis that results in the devaluation of the world's currencies. Jim Rickard's theory that we all finally figure out we can't devalue against each other because that's a zero-sum game, but we can all devalue against gold, does make sense. And the question is, do we get there via some huge crisis or via the political decision on the part of the guys in charge that the game is pretty much over and that they have to go back to some form of sound money and they have to devalue to get there? So one way or the other, that's the inflationary outcome of this. And I don't know, I don't know which one happens because we've never been here before. And so much of it depends just on the decisions of individuals under pressure. The policymakers of the world right now these guys are not the super geniuses that they would like the markets to believe. They're regular people who are operating with flawed theories and are now under huge amounts of pressure. So who knows which way they jump and how they behave when the time comes. But I think the only thing you can say with certainty is that the kind of volatility we saw last week and the week before is in our future again out there somewhere. And that makes it very hard for investors. I know people who have regular mutual funds in their 401ks or in their IRAs that have been doing pretty well lately, but are terrified right now because they had a scare in the last couple of weeks and they don't want to give up their gains, but they don't know what to move their money into because if they go into bonds or cash, they don't get enough income. They're not generating the kind of cash that they need from that money. And so they feel kind of trapped in assets that are very possibly going to hurt them badly in the future, but they don't feel comfortable selling because they don't know what else to do with the money. It's a terrible time to be an individual investor who depends on the income from their investments.
Yeah, much better to be somebody who's dependent on the government because it's a lot more predictable what's going to happen there than to be somebody who's trying to take care of your family, who's has some savings, who's managed to acquire some wealth over your career. Then you're really up the creek. But more on this up next on the Financial Survival Network.
FSN Radio. It's all about what's next.
Every week the show is growing. Would you like to be a part of it? Then go to clubfsn.com and help support us with $1, $2, $5, or $10 a month and get a host of premium content with newsletters dropped into your mailbox, free books, private audio clips, webinars, and much more. Then join clubfsn.com. If you want to get ahead of the trend and ensure your family's financial security before it's too late, go to clubfsn.com and sign up.
The Financial Survival Network. It's all about what's next.
In case you just happened on, it's the Financial Survival Network. We're talking with John Rubino like we do every Monday, and the Fed is up the creek without the paddle. Unfortunately, you're the one who's going to drown because, much like the medical profession, John, when the Fed screws up, they bury the mistakes. Unfortunately, you're the one who gets buried because it's your wealth that's on the line. Because when Ben Bernanke goes to the bank and tries to get a mortgage, well, first he gets rejected. But for some reason, I just think that the CEO of the bank will come through for Ben Bernanke, but he's not going to come through for you, is he?
No. When the time comes, you're going to be left to your own devices. And, the policy of the last few years has been to push individual investors and professional investors further and further out on the risk spectrum. In other words, make cash trash so that you convert your bank account, for instance, into growth stocks or junk bonds. And the hope has been that by pushing up the value of those assets, that the people who've been herded into them will feel richer and then start buying more stuff. And so that's called the wealth effect. And they're hoping that is what will get the economy growing again. But it hasn't worked. And now you've got this whole generation of people who are in assets that don't make any sense for them. I actually just got an email from a friend the other day who said that her folks are they're retired, and they gave their stockbroker a risk profile of very conservative, like 2 on a scale of 10. That's the amount of risk they wanted to take on. And then she looked at their portfolio, and the broker had them in junk bonds, international growth stocks, and U.S. blue chip equities, and that's what they define now as a conservative portfolio. And she's telling her folks that you could lose 40% of your money in this portfolio if the market cracks. And they're saying, well, what else can we do? We don't have anything else where we can make any money, because look at the interest rate on their fixed income choice in this mutual fund family. It's like 0.2%. What are we supposed to do with that? And so her folks are stuck. And we have a whole society of people like that now, and who are in junk bonds. Retirees in junk bonds. Oh. What kind of a crazy world is that?
Insane.
Yeah, and so when the market does finally correct or go into a bear market or whatever's happening next, whatever the resolution of the current extremely stable bull market turns out to be, those are the guys who are going to get hurt. Their pension funds are going to get less able to pay them when the time comes, and their 401ks and IRAs are going to drop dramatically in value. And then they're really not going to be able to generate any kind of income because their capital is going to be so diminished. So
yep.
Yeah, there's no way you can look at the current policy of pushing regular people further and further out on the risk spectrum and think that it's anything else other than some kind of a wealth confiscation perpetrated by the guys in charge. The bankers are reporting record earnings, and they're making huge bonuses and everything, while their clients are taking bigger and bigger risks and in more and more danger all the time of losing big chunks of their capital. So I don't know. It's easy to get cynical and really, really negative about today's world, just because you see the people in charge doing things that are really not in the interests of their citizens.
Yeah.
And so, and so it's hard to ascribe benign motives. You could look at them and think, well, they're just doing the best they can with the economic tools that they have. But you know what? It's hard to believe that. It looks way more likely like they know what they're doing. They know where the money is flowing and where it's flowing from, and they're going ahead with it because it benefits them in the short run.
Yeah. And, we've talked about this before. Individual investors should never, ever own junk bonds, according to Benjamin Graham, the father of modern investment theory. Okay. He said this, I believe it was in Securities Analysis, but if I'm wrong, it was in one of his later books. I read all of them from cover to cover multiple times, and I won't tell you that it ever helped me make any money, but it definitely helped me not lose money. And it's just so damn dangerous because, if you buy those junk bonds when rates are at their peak, okay, and when everybody else is shunning them, then you might just do well on them, and then you dump them at the peak when interest rates are at their low. Okay, but generally, individuals are never in a position to basically properly assess the risks associated with junk bonds. You're just not in a position to do it. And even pros get burned on these junk bonds regularly. Witness what happened, 6-8 weeks ago, where they really got hammered until somehow they got bailed out and they went back up. But as an individual, you're going to get burned on them. It's guaranteed. And while the return looks really seductive, you're going to get burned on them. There's just no question about it, John.
Yeah.
You're going to get nailed.
The problem with junk bonds is the word bonds in their name, because they're really equities. They behave like stocks in the long run. And because what happens to a company that's issued junk bonds who then defaults is they basically convert those bonds into equities. That's what happens when they get into trouble. And so junk bonds tend to behave like the S&P 500 or whatever. So you think you're in a bond portfolio if you're a retiree, and you think, oh, bonds are safe. therefore I'm generating safe income. Well, what you're really doing is investing in equities that pay you some cash in the short run, but that can fluctuate the way the rest of the equity universe fluctuates, and which means that you can generate 8 or 10% a year for 3 years and then lose 50% of your capital in the fourth year. Yeah. And that's actually how junk bonds work a lot of the time. In the long run, they're really not that good of an investment.
Yeah. And unless you're really a pro, like after Drexel Burnham Lambert blew up, okay, and the market for many of these junk bonds went with them, then the guys from Drexel Burnham Lambert went back and found they went through their portfolio, went through the whole thing, and picked out the nuggets from it. And they made hundreds of millions of dollars off of it. Leon Black, I think, was one of the guys. And some guys I knew from Westchester County, they just clean clock on them. Mm-hmm. But you are not in a position to do that because you are not smart enough and you don't get to see behind the curtain. So I personally think really bad idea to ever start getting involved with them in the first place, unless you've got an edge that is not available to the average investor. So when you're looking for yield, and even the MLPs, which have been great since 2008, now energy's getting slammed. If you can find them where the yield has really gone up and the cash flow where they aren't cutting distributions on them, that's something that could make sense because they have to pay out their cash flow. And as long as they're still solvent and their cash flows up because they've got long-term contracts for sale, then that makes sense. But junk bonds, don't think about it.
Well, you are right about junk bonds. That the time to make money in junk bonds is after they've been crushed in a bear market, and which of course is the same thing with equities. That's when you want to buy, when the PE ratio on the S&P 500 is 7. Not 37 or 27 or what it is at the peaks of bull markets. And it's the same thing with junk bonds. They will get crushed, and then the guys who can pick out the decent junk bonds and ignore the ones that are just going to go to zero make a lot of money. But that's not something that the individual can do. What happens for individuals is they get put into junk bonds at exactly the wrong time, at the peak of the market. When yields on everything else are way down, junk bonds yielding 6% look pretty good. Where at the trough of the market, after a crash, a junk bond mutual fund might be yielding 14%. And at that point, you're being paid to take on the risk.
Great point.
And so what's happening over the last few years is the junk yields have gone to record lows. And financial advisors have been putting their clients into junk bonds, because that's where you can get 6%. You can't get 6% anywhere else out there, and that's maybe the target that a retiree has with his money. He needs 6% in order to live off of it without having to eat his capital.
Yeah.
And so that's where he ends up at exactly the wrong time. Yeah.
Yeah. And it's a bad sign that the yields are that low, that they're that close to prime debt. Because that's showing that the market is not differentiating credit risks, because by their very nature, they call it junk because it's not rated.
Yeah. And, well, what investors are assuming right now in the junk bond market is that everybody can refinance. So nobody defaults because there's easy money that's available that you can use to roll your debts over for another 5 years or 10 years or whatever. But of course, when there's some kind of trouble, when equities tank or interest rates spike or whatever, the economy slows down, that changes things, and a lot of junk borrowers do default. Mm-hmm. And so default rates are what a lot of junk bond fans point to at the peaks of market cycles. They say, well, look, the default rate is only 3.5%. That's historically very low. That means the sector is healthy. But what that really means is that these guys are able to borrow because there's easy money. And as soon as the easy money spigot is turned off, the default rate spikes. And this happens every time. every cycle. And so a 3% default rate becomes a 9% default rate in the space of a year. And all of a sudden your junk bond mutual fund is just getting crushed. So
behaving like junk. And it's the same thing with credit card debt and auto loans and mortgages and everything else. And on that note, off we go. So find John at dollarcollapse.com. Buy his book. We've got a link to it on Financial Survival Network, The Money Bubble, that he co-wrote with James Turk. And don't forget, sign up for our newsletter. Take a look at the site. I think you're really going to be impressed by the work that our webmaster, Stefan, does in culling through articles all over the place, places like Casey Research, Agora, The Daily Reckoning, as well as mainstream publications to bring you the news that's really going to help you survive and thrive and figure out what is going to happen next. And if you want to support the show, clubfsn.com, clubfsn.com. John, next week.
Thanks, Kerry. Talk to you then.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.